the EPF fund is the most common deduction that you will see in a salary slip with respect to contributing a certain amount for building a kitty for your retirement. It is not uncommon these days to look at a salary slip and also find a deduction which is known as a contribution towards the National Pension Scheme. While the EPF fund was set up way back in 1952, the National Pension Scheme is a relatively new scheme launched by the government in the year 2004. When you look at the contribution made towards an NPS fund, it is generally an amount equal to 10% of your basic pay versus 12% of the basic pay in case of a employee's provident fund. So 10% is contributed as an employee's contribution and a similar amount is matched as a contribution made by the employer. So if you were to see a salary slip with a NPS contribution being made to build the retirement kitty of the employee, you will find that the deduction would be an amount of 5,000 plus 5,000 in case of the example of Rocket Singh instead of a deduction of 6 plus 6,000. Now, how does NPS exactly work? While in a EPF fund, you deposit an amount and you are assured a fixed return on a year-on-year basis, it works very similar to what we know as a fixed deposit, in this case being a deposit with the government. In case of an NPS, the way it functions is slightly different. When you invest your money in an NPS scheme, you as a subscriber of the scheme get to choose whether you want the money to be invested in government securities, you want it to be invested in corporate debt, you want to be invested in equities. So a major difference between EPF and NPS is NPS allows you to invest in equities as a asset class, or you would like to have the money invested in the alternative investment fund, which is your alternative investment options. Now, if you look at it by its very structure, an NPS is going to be a much more riskier investment compared to an EPF, because the EPF works like a fixed deposit where the return is guaranteed by the government of India. So it's largely a risk-free and a tax-free return. In case of an NPS, you put your money into various securities wherein the returns that you get are determined by the market returns. So in a year equities do well, your fund would do well. In a year government securities do well, your fund would perform accordingly. So as an employee, you contribute money to an NPS and you also get to choose how much of your money you would like to allocate to these various asset classes within the boundaries or limits set by the NPS management. So if Rocket Singh were to start contributing an amount of 10,000 rupees per month towards the NPS scheme, he would continue to contribute this from his current age of 22 till he reaches the age of 60, that is for a total period of 38 years. At the age of 60, his NPS would have grown to a certain corpus depending on how the markets perform, and the entire lump sum amount is split into two parts. 60% of the entire lump sum amount is paid out to you as a subscriber, and the balance 40% you have to compulsorily use it to buy a insurance annuity policy. What the annuity policy does is 40% of the corpus you would give it to an insurance company who would give you an annuity policy, which effectively converts your 40% lump sum into monthly cash flows, that is your monthly pension. So basically what the NPS scheme is doing is it is helping you accumulate a corpus during your good years when you are earning and converting that corpus into a pension scheme the day you retire, so that pension scheme can then start paying you a monthly pension on a regular basis and you're not dependent or you're not left without any retirement support during your retirement years. While a EPF fund will pay out the entire 100% to you, a NPS fund will pay out only 60% to you as cash in hand for you to do what you want the day you retire. The balance 40% is compulsorily invested into a annuity scheme from an insurance policy, which will start paying out a monthly pension to you. Just like the earnings from the employees provident fund are tax free in your hand, similarly the earnings that you get from the national pension scheme investments also continue to be tax free till you withdraw them at the time of your maturity when you hit 60 years. Your entire returns during this period continue to be tax free in your hands, because of which it also works out to be a very good alternative when you look at putting aside money for your retirement kitty. That is, you have to, as an employee, you can choose between a EPF fund and a NPS fund.